Well, we know Tesla is one of the most, if not the most volatile large cap stocks ever in the history of the stock market. And it seems like nobody has the right answer as to when to buy or where Tesla stock is going or anything else. I mean, one day everybody's saying buy, next day everybody's saying sell and then go short, and then buy again and go all in on margin. And it's just ridiculous. Unfortunately, it's probably the most commonly bought stock that falls into the category of I just bought it at too high of a price. And that is a devastating to make, to say the least. So let's talk about the right way to buy Tesla stock, especially during a time like right now where it's basically on a rocket ship up. I mean, we're up massively in a super short period of time. So let's talk about the right way to buy it. And I'll give you a complete guide to doing exactly that. And the really good news is you can apply this to any stock in the stock market. So even if you don't like Tesla, I totally understand, or you're not interested in buying anymore, you can still apply the same strategy to another stock that finds itself in the same exact situation. Just make sure you like the video if you like getting the truth without the hype, and make sure you do that for all the creators you like, guys. That's exactly how you show us and YouTube that you actually enjoy our content, is by just hitting that like button. It's free to do, super easy. So make sure you do that for everybody that you like. All right, so I'm actually going to give you two ways to buy Tesla stock, not just one. We're going to talk about two of them today, and you can obviously modify these as well to kind of suit your needs, but it's going to give you a baseline, kind of a guide to go off of there. And of course, you can just follow it straight up as well if you want to, but modify it as you see fit. All right, so first up is to just DCA. DCA stands for dollar cost averaging, guys, and it's really where you simply buy in regular intervals, kind of the same amount of money towards the stock on a set schedule there. So essentially, every paycheck, I'm going to take $500 and I'm going to buy $500 worth of Tesla stock every paycheck. We'll just say the Monday after my paycheck post or whatever the case is there. That is simply a DCA. You're going to do that whenever it's high, whenever it's riding low, whenever it's beat down. It doesn't matter. When that paycheck hits and that money comes available, you are taking that money and you are buying Tesla stock that day, whatever price it's at, you're buying and you are moving on with life. The beauty of this method, and this is kind of the part that's really, really hard for us to hear as retail and really, really hard for us to hear as people, because we all want to do better, but it is statistically virtually impossible to beat because it's eliminating emotions. It's taking all the variables that come into investing out that end up screwing us as investors. It takes it out of all that. One of our expert coaches in our group proved it out with math in one of our coaching sections, where they kind of walked our members through all of the data that's out there. Goldman Sachs has data that's out there. There are all kinds of other studies out there that show it is really, really, really hard to beat somebody who just simply DCAs. And oh, guess what, guys? In terms of if they did a health study, they haven't, but if they did, I'm going to guess the guys that just DCA or the gals that just DCA, they are a lot less stressed than everybody else. I know I'm a lot less stressed than all those trader folks are. And I can't imagine the folks that just straight up DCA, how much less stress they have than I do. I don't really stress out in the stock market. I actually get excited. I enjoy it. I love it. But I can't say that those folks over there aren't, on a whole different level in regards to that. They're not even thinking about, hey, money hits the account. They're doing it. I guess you could probably set it up in some sort of automatic something to where it's even less effort than that. And hey, just see where you're at in 20 years. My guess is you're really, really enjoying where you're sitting over that time. Now, one of the reasons why it's so successful is because it removes emotions from the equation, because emotions destroy your investing, especially with an emotional stock like Tesla. That's why you don't go all in at $400 because of FOMO, right? When it was at $400, everybody wanted to buy that stock. I got destroyed. My group actually went down in terms of size. My comment section was just filled with people telling me I'm an idiot for not buying at $400, and then flipped that on its side. Whenever, it inevitably came back down like we talked about, and it got down to that $100 mark or close to that $100 mark, and everybody was predicting it was going to 80, it was going to 60, it was going to 40, whatever the case was. That was fear, and then people sold. So they bought at 400, the buy high, sold at 100 out of fear. All that was emotionally driven. The person that just DCA'd through that entire time frame has a lot more shares at a lot lower average than everybody else playing all those other games around that particular stock. Yeah, they got some shares that are still in the negative, but they got a whole heck of a lot of shares that are on a basically almost a triple up now as well. So they end up doing just fine in the end. And more importantly, share count's what matters. And they have a share count that's going to be really, really hard to beat. And it's continuing to grow month in and month out. You basically put it on a schedule and move on with life. All the research shows it beats trading by a mile. So there's no need to chart all day long or freak out on the latest Elon tweet or, whatever the heck he's whatever the heck's going on with him, or care about what all the short sellers are doing or anything else like that. You don't have to worry about any of that sort of stuff. All you have to do is just simply buy and hold. And if you're wondering why Wall Street doesn't just DCA versus trading, it's because that's not how they make their money, guys. Wall Street hedge funds make their money based upon assets under management. So they got to have a good sales team to bring all the assets in, right? And then they don't make money by simply Tesla going up. They have to take a profit. They have to make money because whenever they make money, whenever they book a profit, they take a percentage of that profit. Oh, and by the way, if they put on a trade and it happens to go backwards and they end up having to get out of the trade and they lose the investor money, they don't pay the investor back out of their bonus either. So they're incentivized to not DCA because at that stage, when are they booking their profits? They're not. Therefore, they can't take an extra percentage. Therefore, their bonus is smaller. So they're playing a whole different game. They don't care about what this sort of stuff's going long term. They care about trying to increase their bonus in the end because they're playing with somebody else's money, not their own. But if you're playing with your own money, it is really hard to beat a DCA, but it can be done. So let's talk about number 2, and that is a modified DCA. So how exactly do you do a modified DCA, and what the heck does that mean? What is going on? The retirement savings crisis. Why more Americans can't afford to stop working. The retirement savings cliff. The number of Americans in the labor market over the age of 75 is expected to nearly double over the next decade. Democrats and Republicans finally agree on something. America faces a retirement crisis. Why you will never retire. That looks incredible, but that's kind of weird the way that thing just keeps popping in here like that. Anyways, back on track here. How do you execute a modified DCA? There are lots of different examples on how to do this, but I'll give you guys a couple right here just so that way you can kind of see it illustrated in real life, because I think that's kind of the best way to describe it is just simply to give you guys examples. Now, it's like a DCA where you're buying on somewhat of a regular schedule, but if it falls and hits a certain price, at that stage, that's when I add to my DCA. So basically you set it up in increments. So obviously I'm saying, hey, I'm going to DCA into the stock. But if the stock falls and hits a certain point, I'm going to actually DCA heavier into the stock at that stage. So, and obviously if it continues to fall, I set up that next level of DCA and I'll DCA even heavier after that. And the same exact thing works in reverse whenever the stock runs. You don't have to stop your DCA. You just simply lessen the DCA and kind of pool that extra cash for those downtimes that we just talked about, where you increase your DCA down at the bottom. Basically kind of set the price you want to slow the DCA at above fair value, we will say, and then slow it down as it continues to hit those increments. So you see how we bought less at $400 per share using this strategy, and then we bought a whole lot whenever it was down at 100 without having to time the market or do anything else, just simply executing a plan based upon where Wall Street was moving the stock at the time. Now, I agree you have to understand valuation in order to do that. That's why valuation is so important. So that way, regular DCA, whenever I'm paying right around a fair price, above or below, you don't want to do these in like $5 increments or anything crazy like that. You basically, hey, regular DCA, hey, Wall Street wants to get dumb, pump it up real high. Okay, I'm going to back off a little bit. Still going to DCA because, the strategy still works. Just going to buy a little less. And then the same exact thing, I'll pull that money off to the side here for when it gets really cheap and my DCA comes back down, right? You do your regular DCA again for a while, then all of a sudden, for whatever reason, I don't know, Elon says something crazy on, Twitter, X, whatever. And so therefore Wall Street wants to get silly and start speculating. Okay, they beat the stock down. It goes down below fair value, not just below fair value, but significant down below fair value, wherever I set that marker at. And now I'm going to buy a heavier DCA, still execute on my regular schedule and everything else, but that DCA buy is going to be heavier. It is simply as simple as that. Again, no time in the market, no craziness, just simply backing off a little bit whenever Wall Street gets crazy, which they do with Tesla, And then whenever it gets beaten down, because they also get crazy to the other side with Tesla, that right there is when I'm buying more shares. Not trying to time anything, not trying to do anything else. Just simply it's predetermined, planned, and more importantly, the cash is set aside in order to do that. And I just execute. That's it. Now, the second method is honestly a little bit more complex, but it kept me from buying at $300 and $400 and instead had me buying like crazy all the way down to $100, with the buys getting heavier and heavier as we kind of went on that journey down. So it was, I won't say it was easy, but it was easier for me to do because I've been doing this for over 25 years now. And this is one of the methods that I teach in my group, that this is how I personally chose to do it. But again, it also comes with the caveat of, hey, I've also been doing this for 25 years. So for me, this is a strategy that's kind of been developed over that time. So I'm very, very comfortable with it. Now, it's not easy and you're going to make mistakes at first. And so did I. That's okay in the end. When you make mistakes, one, you're never going to get the tops and the bottoms right, right? And you just got to get that out of your head. So you're going to make mistakes. Obviously, it's just a question of how big of a degree of the mistakes are. But the point being, a great stock always bails you out over the long run. So that way you don't have to worry about that. We all believe Tesla's going to be a great stock over the long run. It's going to bail you out at some point in time in the future. Even if you make a mistake, it's going to take care of itself over the long run if Tesla goes to where we think it's going to go. So starting off, you basically do evaluations so you can get a price target. I know we've talked about that 100 different times here on this channel. That right there is almost the key to investing in general, is getting that price target. Just start with fair value as your price target to keep it simple. So find that fair value, do that valuation, find that fair value, set that right there as your price target. So that's it. If you don't know how to do that, you got to learn that first. Learn that valuation so then you can find fair value. When you learn that, it makes investing so much easier to understand when you're overvalued, undervalued, and what to do in those particular scenarios. And essentially, after you do that, is you simply have the patience to wait for your price target. Now that's hard. That requires patience. That requires confidence in your skill of finding fair value and feeling confident in that fair value. That's why a lot of folks, I recommend just doing a straight DCA to begin with, because until you get more comfortable doing this and more practice doing this, it's very, very hard to do right off the bat. So yeah, it's hard, requires a little bit of patience. But after that happens and you're waiting for that price target to hit, it hits your target and then you DCA down until the position is full and you're only needing bonus shares of this company. So basically you just, hey, you kick off your DCA and you start building out your position there whenever it's undervalued. And again, because it's undervalued, yeah, it could go lower after you fill out your position to full, right? That's okay. That should be something that gets you excited, because once you have a full position, if it's a great company, I'm okay with buying a great company and adding more shares than I want, more shares than a full position, because who doesn't want to own more shares of a great company? But the caveat to that is I only want discounts, and in some cases, big discounts, before I buy those stocks again, because I have a full position. And that's exactly the scenario you're in. So in those particular scenarios, I filled out my position, I already have a discount. I'm no longer I care about fair value because I want to know where it's at. But then I'm setting my price target for a great company that I wouldn't mind adding bonus shares to at a price target that's well below fair value. And then when Wall Street gets dumb, which will happen sooner or later, it makes it to where I'm able to add shares only on a significant discount. Just this year with Tesla, this year, guys, I didn't buy any of the other stuff that was going on. I patiently waited for 169 and then I bought again at 142, 141, somewhere right up in there. Those were my buys in Tesla this year. And look at where we're at right now. That's what I mean by getting those bonus shares. Obviously, somebody who was looking to do this particular method and with Tesla this year, well, if you had fair value, we'll say pegged at, I don't know, $210, $220, whatever the number ended up being. Every time it got down below that, you were DCAing. So you had a pretty good chunk of time this year to build out that position. And look at how much you'd be up right now utilizing that particular strategy in just a very short period of time. If I could talk, I would say the word time. Anyways, the point being, hype runs make this harder like we're in right now because everybody is buying and making money. And that makes the strategy really, really hard to hold on to. I heard it all back in 2021 when Tesla was at $400 and people were mad. And I said it was way overvalued and coming down. And we're not in that situation today. Let me be very clear. We are not in that situation today with Tesla stock. However, back then it had a multiple of 1,000, and yet people were still telling me that I was crazy for saying it was overvalued and it was coming down. And guys, that wasn't rocket science. That was just simple valuation. I knew better. I stuck to my plan and I held on to doing my modified DCA because I knew better pricing was coming. Now I had no idea how much better it was going to get. I didn't have 100 on my bingo card per se, right? But I definitely had 250 on my bingo card as to where it would go. I definitely had 200 was a possibility, or getting underneath 200 was a possibility. Like I said, I didn't have all the way down to 100, but I definitely knew that. But the one thing I knew for certain was I was going to get far better pricing than 400 at some point in time in the future based upon valuation. Now, again, we're not in that scenario today. It's a very different company today in terms of, revenue, profitability, everything else than it was back then. But nonetheless, the strategy stays the same. If we're talking about speculative positions, I don't keep DCAing in those unless they perform quarter after quarter after quarter. But a company like Tesla or a Palantir or an Apple or any of the other great companies out there, I'll keep buying those stocks when they get undervalued. And then when the stock runs, I back off once it hits that number again, pulling up cash for the next time it comes back down again. Because remember, stock doesn't go up in a straight line. The trend line may be that way, but it goes here, then it goes undervalued, then it gets overvalued, then it gets undervalued, all the way up there. And I try to just take as much, off, be on the bottom part of that trend line as much as possible there. That's all that it does in the end. Now, what I can tell you today definitively is I have used all these methods discussed today and they all work. And if the modified DCA seems confusing to you, just do a regular DCA until you get comfortable with that, or just stick with that altogether. That may be best. There's nothing wrong with that. Just don't fall for all the hedge fund, YouTube garbage that is out there, like buy now, then sell here, and then short there, and then buy again on margin, and all this other goofiness that goes on out there, and then jump out and jump back in, and all the other craziness like that. Statistically, you will lose if you do that. Here's the facts. Here's the final fact to keep in mind. Dead people beat traders statistically, and that study was put out by a trading firm. Dead people outperform them. So keep it simple in the end. And I know valuations are hard. That may be the hardest part about investing. And if you want help with that, consider joining my group where we do exactly that. We got 5 courses geared towards that. We have free coaching that you can take advantage of to do that. Obviously, everybody in our Discord there is happy to help you out. We got lots of 6, 7, 8-figure investors in there who are absolutely crushing it, who are more than willing to help you out. We got lots of exclusive videos. We got live Q&As. Like I said, we got the coaching. And for those of you that stuck around this long, I may have left something special for you down there at the pinned comment. There's so much involved. Check out the pinned comment, see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see the exact plan for this market. Thanks for watching, and we'll see you in the next one.